Good morning, good afternoon, and good evening, folks. I am not Michael Zuber. I'm Millennial Mike, but I'm here with the three amigos today because Mike is spending time with his family on his days off, weekends, whatever. So, what I have for these guys is a question that somebody sent me in an Instagram message. Now, I'm going to try to summarize the question and keep it simple so everybody can understand, but it's a question about interest rates, payments, balloon payments, and what their long-term strategy should be. So, I'm hoping that Matt and Dion can give them a little bit of advice. So the question is as follows. This individual picked up 6 seller finance units with a seller financing guy. He got it amortized over 30 years, which is really good. And he got it at a 3% interest rate, also really good. However, there is a balloon payment due at 5 years. And what that means is that the entire amount is due in 5 years. So what he's asking me is, hey, Mike, to me, should I refinance these seller financed deals with a bank? Do a refinance with a bank, get traditional 30-year fixed rate debt, no balloon? But the question, of course, is, well, interest rates are 7.5%. So right now he's cash flowing really, really well with 30-year AM, 3.5% debt. He would be cash flowing way less if he goes to 7.5% interest rates. But his concern is, if I don't do this now when interest rates are 7.5%, 5 years from now, when my bills due, are interest rates going to be more? Will values have gone down? What I know now versus what I don't know about the future. So first to Matt, what would you advise this guy?
So I would never advise on anything like this because that'd be financial advice. However, I will tell you the math so you can figure it out. So the math to figure this situation out, when you're looking at 5-year temporary debt that's going to balloon, you're going to have that payment. What you need to look at is balance it against the 7.5% or 7% rate that you're getting quoted right now. Look and see what that monthly churn is going to be, i.e. my payment's $2,000 a month at 3.5%, it's $3,000 a month at 7.5%. So I've got $1,000 a month for the next 5 years, which is $60,000. And that's what I'm looking at giving up if I go to a 7 right now. Then do I actually even still cash flow at 7 or 7.5? Do I cash flow at that number today? That's the first step. The second step is, once you've evaluated and said, this is what my current rate is, this is what my future rate is, and now how do I then understand if I should even do a deal like this? You have to be a really good guesser. This is why nobody does it, is because they have to guess and say, well, what really are rates at that point? They could be 7.5 still. They could be 9.5. They could be 5 again. It's absolutely impossible to forecast what that is. So if you look at it and you say, I'm going to create an extra $60,000 in cash, it depends on what the balance of those loans are, because this might be something where I put extra money in paying those items down over the next 5 years to know that I'm going to be able to refinance them. But if property values are down 40%, you can't refinance them. You're going to be stuck in that regard. So really, it's a math question, and it's understanding what is the delta between what I'm paying now and what the rate is now, and what's that going to cost me to give that up for 5 years, and do I then cash flow at the $3,000 a month? Do I even still cash flow at that number? Because the real risk is if you don't cash flow at that 3,000 number, because you can do it right now today, and maybe that brings you from $1,000 a month in profit. Maybe it brings you, or $1,500 a month in profit, to only $500 a month in profit. Can you live with that $500? Then that probably makes it a skinny deal. So a lot of people that have been successful in the past have gone both ways with this. They have done a deal with 5-year debt on it at a much, much, much lower rate. But then their idea was, it's because I'm going to get good principal paid on and I'm going to sell out of that deal in 5 years, or I'm going to be able to refi that at some time in the next 5 years. Most time horizons that I think people should be looking at on adjustable rate debt is 10 years, because there's almost always been an opportunity in a 10-year period where you can refinance that debt cheaper than you bought it. In this particular case, with rates likely rising, when we go into recessions, rates go down. The question is, will they go down as much as you need it to? Maybe it only goes down to 5%, maybe 4.5%, maybe 6%. So what you have to do is make sure you're running your numbers so you know what that cost of a delta on a monthly payment is going to be for you, and what your monthly rents are, so you can actually figure out what your net is on a monthly basis. That's just the math side of it. The emotional side of it, we'll leave for Dion.
All right, perfect. Thanks, Matt. Yeah, Dion. So, what would your non-financial advice opinion related to this topic be?
Definitely more based on emotion. That's why I'm glad you went with Matt first, because he has the portfolio of a size where he could do deals like this. And if they completely go sideways, he has the revenue to handle it. His portfolio can handle that risk. I want to talk about two things. First, all of my deals are from the MLS with traditional lending, 30-year fixed rate debt. I would not do a balloon payment or an adjustable rate or a loan reevaluation type of loan product, no matter what, no matter the return, no matter how much it cash flowed every month right now. I want financial freedom that comes with mental peace. That's where the emotional part comes in. I never think about, care about interest rates, home values, doesn't matter. I don't lose an ounce of sleep thinking in 5 or 10 years, I will have to do some type of refinance, rate adjustment, balloon payment. So that SWAN account, the sleep well at night, that comes from fixed rate debt. That's the emotions. I wouldn't do this deal. Second, I want people that are considering doing a seller finance deal to not think that balloon payments are normal.
Right.
A lot of times sellers are selling with seller financing and you're educating them. They didn't even know this was an option. Their agent said it was illegal. Right. And then you finally break down the barriers of uneducated agents and say, look, this is a real way to do things. You carry a note. I can pay you interest instead of the bank. You can sell your properties without a large capital gains hit. Like there's all kinds of reasons why seller financing works. But sometimes the buyer speaks into existence the balloon payment or the 10-year interest only or the weird amortization schedule. Because my brain breaks when somebody says, I have a 30-year amortized loan with a 5-year requirement to pay it all off at the 5-year mark. The confused mind says no. I would have said no right there. So that's the two things. First, if you have a smaller portfolio, 7 properties, 16 units, couple $100,000 in profit a year, I wouldn't touch a balloon payment product, period. Second, don't speak into existence something like a balloon payment. Say the things that are in your benefit. And if it's the only way to make the deal happen, and you have a portfolio like the Lumberjack landlords with the cash flow to handle 30% interest rates in 5 years, because then you just pay off the properties, sure, go for it. But don't gamble. This is not a gambling investment asset class.
Yeah, I like both of these takes. I like them a lot. I would add one more piece of info to what Dion said. The other alternative for you to mess around with a balloon is if you have cash on hand to just pay it off immediately. You know, I have a $35,000 seller financed house. I put 20% down, so I only have $27,000 on the mortgage. If I had agreed to a balloon on this, at any point, I can just drop 27 grand. It's not going to hurt me. But if we put a 0 on all those numbers, which is what Matt plays with, everything that I do, you put a 0 on it. And now it's a $340,000 house and I have to drop $270,000. Now I'm a lot more scared of that deal. I really like seller financing. The seller finance deals I did were 15-year mortgages. Guy's in his 70s, doesn't want to do a 30-year mortgage. It's understandable. He won't be here that long. But I got 4.9% fixed rate at 15 years, and I bought them so cheap. I got them so far under market that even with less years on the amortization, they still cash flow really well. So I like also what Matt said. He and I had this conversation last night when we were spitballing my strategy moving forward to go from where I'm at now to one day being more like him and like Dion. You need to plan for every eventuality. Part of your tactics and your strategy is to plan for contingencies. In the SWAT world, when you go up to the front door and you try to breach it and it's a failed breach, you can't get through. We have an immediate contingency, alternative secondary breach point around the back. And then we have our tertiary contingency, which is off the top of the armored vehicle into the second floor. So if you plan for every contingency, every eventuality, then when these types of things happen, or if they get sprung on you, you just pick your best alternatives to your ideal plan. But obviously you go with ideal first. Guys, I appreciate the advice. I'm going to send this video to the Instagram follower. I can't remember your name or I would have cited you, my friend. Thanks for being here. Matt, where can people find you?
Lumberjack Landlord on YouTube and Instagram, as well as my live stream 11:30 a.m. on Sundays.
And Matt's actually releasing a brand new course. It's going to be at the lumberjacklandlord.com. He's really excited about that. It's going to be about how to manage your own properties from anywhere. Dion, where can people find you?
Right here on YouTube, Dion Talk Financial Freedom, where every Tuesday at 4 p.m. Pacific, I do a live stream and answer questions like these.